Ramanpreet Sohi is the Chief Financial Officer at Honasa Consumer, here to talk about the robust performance. And thanks so much for taking time out. A 21% year-on-year growth this time around. And, the company has been talking about delivering this 30% growth rate going forward. Is that looking achievable? And what will be the drivers?
Hey, hi, good morning to all. Thank you so much for having me. So I think, what we've also indicated is that you actually need to look at H1 results. I think we've delivered a 33% year-on-year growth and a like-for-like growth of almost 36%. Most of it is volume-led. So we're seeing good traction. We are focused on investing and building our brands. Our younger brands are doing really well. All of them have achieved new milestones during the quarter. Our largest brand, Mamaearth, continues to scale. We continue to build our brand on the offline side. Our distribution expansion increased by almost 47%. Year on year, we've reached almost 1.65 lakh retail outlets. So I think our focus on building brands and focus on expanding our distribution, strengthening our distribution is working well, and we continue to double down on all of these things.
Which are the categories where you think you would be able to, in a sense, grow and maintain this kind of a growth rate? Because there is the traditional FMCG business, which is now reaching a mature curve. But the categories which you represent essentially are very niche and have an online presence. So which are the categories where you're confident of exceptional and strong growth?
Yeah, sure. I think just to clarify, almost 40% of our business comes from offline now. And hence our brands and categories, especially Mamaearth, is largely the focus in terms of incremental growth is coming from offline for us. We are present in multiple categories, face cleansers, moisturizers, shampoos, oils, and also emerging categories like sunscreen. We're seeing good growth across categories. Of course, we are also focused on the market share game here. So I think we're seeing good gains across categories. But of course, some of the emerging categories would be serums and sunscreens for us. I think that's, as categories, they're also something that we're seeing penetration gains coming in for these categories.
FMCG category, if I talk to some of the large established brands, whether it's local brands or global brands or MNC companies, they are saying the following: penetration has already happened, volume growth is low, and the base effect has kicked in. But if I hear the commentary, what you just stated, you pretty much are saying the opposite of that. Penetration has started, category growth is strong, and we are confident of a double-digit growth.
No, absolutely. I think one thing I want to call out there is that we are focused on masstige and mass premium categories. And I think as a business and as a house of brand, all our brands play in the mass premium, masstige categories. And this space is expected to grow at almost twice that of the mass segments in the country. I think given that and how the whole online, offline ecosystem is evolving, we're fairly uniquely positioned to capture this evolving opportunity in the beauty and personal care space.
One of the concerns that the street had at the time of IPO was the high advertisement spends, right? Talk to us about the trajectory of bringing it down and how the operating leverage will kick in, because this quarter as well, we have seen an improvement in margins. What could be the trajectory going forward in terms of margins?
Sure. So yeah, I think from a first half perspective, we've delivered 7% EBITDA margin for first half. We expect a similar kind of a margin profile for the rest of the year. That's our endeavor, so that and the expansion in margin that we're seeing in H1 is more structural. It's something that we think will be sustained. Most of it, as you rightly said, is led by leverage, and leverage kicking in two particular aspects of a P&L. One, of course, is the A&P. We saw almost 260 odd bips of A&P rationalization, and of course, we think that that's something that we had planned for, given how our brands are scaling, how Mamaearth as a brand continue to grow as we invest and grow that brand. Also, as the younger brands grow and mature, we are clearly seeing leverage in A&P, and also across other P&L levers. Payroll cost is the other aspect, and other overheads we're seeing leverage kick in, and hopefully that's the focus. Focus is, of course, continuing to grow and deliver a market-beating growth, but at the same time ensure that we grow efficiently as well.
Once your offline strategy does scale up, because you articulated that during the IPO as well, do you think the ROC etc. will kind of take a dip? And how are you looking at the entire offline strategy in terms of the pace of expansion?
Sure. As you see, we are a negative working capital business and a very capital efficient business in our journey so far. And in this journey, of course, our focus on offline is a 3 to 4 year old channel for us. We're doing really well there. Our execution has been pretty good. But at the same time, if you actually look at our capital efficiencies there, we've continued to maintain our working capital cycle. So I think our focus there will continue. The business, of course, is capital efficient, doesn't require that kind of a cash investments, in terms of how the channels are panning out for us. So we don't see that, too much of a deviation when it comes to capital efficiency of the business. Even today, 35% of the business is offline and we are negative working capital cycle. So I think that's how we are positioning and we're fairly confident that that's how we'll continue to deliver and build this business.
Fair enough. And what is going to be the next hero product? And can you also tell us a little bit more about how some of the hero products compete with the large, very well established FMCG players? So what's the strategy to deal with that?
See, I think in terms of our focus, innovation is a key strength. Almost 13% of sales for the period has come in from innovation. That continues to be our biggest growth driver. We continue to focus on innovation based on data science tools that we have in-house. That's one of the key strengths for our business. And of course, we want to stay ahead of the curve and continue to innovate. Of course, some of the innovations, we've launched recently have been focused on ingredient innovations like rosemary, multani mitti. We're also working on leveraging cultural nuances of the Indian consumer. I think that's a big strength for us, and we continue to focus and build all our brands on innovation-based pipelines for us.
So let's understand the mindset of an investor here. An average investor would say that why should I buy a Honasa stock? Because the return ratios are not best in the industry. Yes, the growth is one of the highest. That's the purist who looks at return on capital, return on equity, free cash flow generation. So how would you tell a new investor saying that your business indeed is different?
Sure. So I think a couple of things. Firstly, of course, on the growth aspect, I'll talk about. We are one of the fastest growing, consumer companies. Growing at almost 3 times faster than the market. Of course, our margin profile is evolving, and now, of course, with our focus on efficiency, we are also starting to deliver and execute on the margin aspect. Also, on the return ratios, as you mentioned, I think we are a fairly capital asset model. If you look at our balance sheet, if you exclude cash. And if I have to analyze our performance of first half, we're almost at 50% plus ROCs if I have to exclude my surplus cash from the balance sheet. So I think it's a business which will, given the opportunity that exists, we'll focus on ensuring that we continue to deliver market-beating growths, ensure the margin profile continues to improve given leverage-driven efficiencies, and hopefully, investors will see us perform and deliver quarter on quarter.
We are in FY24. FY27, 3 years out, when the business would have reached a curve of operating leverage, margins would have kicked in. What is your aspirational number for return ratios, return on capital and return on equity? Where do you think you want to take the company to?
I think the focus is, clearly on delivering growth and delivering growth which is backed by a profitable growth which is faster than top line, given where our margins are, and I think that will solve for itself. Our return ratios will continue to improve. Like I said, if I exclude cash today, we are already delivering 50% plus ROCs, and hence I think that those ratios will continue to improve. I don't think so I can call out an exact number 3 years from now, but clearly we see return ratios for this business, given it's an asset-light model, negative working capital cycle. We don't see that as something that will worry us. I think our focus, if we are able to deliver our growths and continue to grow the way we've grown in terms of growing efficiently as well, we should be very healthy return ratios.
Ramanpreet, so since you're focusing on growth, tell me, is this 35% growth rate what we should expect for the next 12 to 18 months as well? That's what you delivered in the first half?
See, I think, like I mentioned earlier, the focus is the endeavor is to ensure that we continue to deliver growths in a similar range, 30% kind of range, given how we are focused and structured. That's the endeavor for the management.
On that note, we let you go. Thank you so much for making time and speaking with us. A quick